And moderating this segment is my colleague Jackie DeJesus, Maybank Philippines Head of Research. Jackie, Ashish, may I please invite you on the stage, please?
Good afternoon, everybody. So last session of the day. So the day has been brimming with so many interesting perspective and actionable ideas. So I think it's only fitting that we end day one of Invest ASEAN with a session on opportunities, where they are, how to spot them, and more importantly, how to maximize them. So Ashish, thank you so much for joining us. Just to give a little bit of context, could you share with us a little bit of an introduction to what OMERS is?
Thank you, Jackie. I just want to check with the audience, how many people, if you could just indulge me for 1 second, how many people have heard of OMERS? Just raise your hands. So a few people have, and a lot of you haven't. So I've got 4 or 5 slides. This is not going to be a tedious presentation, trust me. Just to give you a little bit of flavor, what OMERS is and what do we do. So OMERS is a defined benefit pension fund. We have about 1,000 different employers in the province of Ontario, Canada. These could be policemen, firefighters, zookeepers, municipal employees. And we have offices all over the world, but in Asia we have 2 offices. Singapore is our main office. We have about 50 investors sitting in this office. And Sydney is our second important office in Asia with about 20 investors. We have about nearly 600,000 pensioners. The oldest one is quite old. I won't tell you her age. But the youngest one, which is very interesting, is about 16 years old. So you can imagine this person it's a lady. She's going to work for the next 30, 40 years. And then she will retire and collect pensions for another 20, 30, 40 years. So the fund's going to be around for a long, long time. And I mention this because you talk about long-term horizons, you talk about permanent capital. We certainly represent that. We are AAA rated. We have some bonds in the market, which obviously trade in line with AAA rating. A lot of our pensioners, these are people who are not very wealthy. They rely very heavily, the pension is very important to them. So the average pension paid out is $32,000 a year in retirement. So we take this task of managing their money prudently very, very seriously. Just a couple of numbers. So for the last 10 years, we've been earning about 7.5%, as the book has grown from around 65 billion Canadian to 125 billion Canadian. Why 7.5? In pension accounting, you have both the asset side and the liability side. We discount our liabilities at 5.75% nominal currently. So anytime we make a return higher than that, we are actually adding to the pension value for our pensioners. So the reason why I mention these numbers is there are a couple of ways to manage your money. You could say, I have a risk budget, and then I want to make the maximum possible return I can with that risk budget. We kind of invert that. We have a return number in mind, which is around 7, 8%, and then we want to minimize the risk, take the lowest possible risk to generate that return. So another kind of snippet of what we do. Just a couple of slides more. So this one gives you a distribution of our asset. It's a very diversified asset base. We have public assets, we have private assets, and I can talk to all of them. Geographically, we were always very focused on North America. That still remains the case. 70% of our assets are in North America. We started diversifying into Europe about 10, 15 years ago, and into Asia about 8, 9 years ago, but more so in the last 5 years. So we have about 11% of our assets in Asia. We plan to take that to some number larger than that, say around 15% in the next 2-3 years. And eventually it will move up to 20%. As we all know, Asia represents 40-50% of the global economy. there should be more opportunity in Europe in the long run. And when I say long run, I truly mean next decade or two. So I wouldn't be surprised if we have a lot more money in Asia over the next few years in a book that's growing. So that 125 billion I showed you earlier will also grow to 200 billion by 2030. And this should, a couple of slides. So one is investing, sustainable investing, very important to us, not just because we as investors, but also because our pensioners demand it. As you can imagine in Canada, the whole trend towards being sustainable and being green is very, very strong, despite the fact that Canada does have some energy assets and some dirty oil even. And lastly, this is absolutely my last point, inclusion and diversity, very, very important, taken very, very seriously. And we have a fairly big effort around this, which is a continuous effort and will remain strong. That's it. That's my introduction to OMERS.
No, very comprehensive. Thank you for that. So I wanted to step back a little bit. Can you describe how the events of the last few years have actually impacted large pension funds like OMERS?
Sure. So again, I'm going to take us all back maybe a decade and what happened during that period, because that was also a period where for a large part of that decade, rates were very, very low. And typically, pension funds, if they have a 60-40 portfolio or some kind of balanced portfolio, will have a large allocation to government bonds. That would have been fairly punitive. If you're trying to generate 5.75% and bonds are at 1 or 2%, you know right up front, that's not a winning proposition. So our strategy, and this has also been done by a couple of other funds that I know of, large funds, was to migrate out of government bonds and use that money to invest in real assets, mostly infrastructure assets. So we could buy a road portfolio or an airport or some other long life infrastructure project where the return profile was at least 8 to 10%. If we could do asset improvements, do other things, typically we buy the asset ourselves and manage it ourselves. We appoint the management, we appoint the board. So we can also do some asset improvements. That would make a return of some low double digit, 10, 12%, which is much better than investing in government bonds at 1, 2%, with also a low risk profile, because these tend to be reasonably low volatility assets if you're buying high quality infrastructure assets. So that's one of the things we did. But also OMERS was very early, even 20 years ago, into this, what is now called, we call it alternate investments, but we just call them private assets. So we were fairly early going into private assets, whether it was infrastructure, which is one thing I talked about. We have a real estate business. We own an operating company called Oxford, which is a developer, which is about as big as Capital Land with about $75 billion in assets. So we invested more capital through that vehicle. We have a private equity portfolio, including venture capital, growth equity, and private equity. So we grew those quite a bit. So they are almost 60% of our book today. And many of our peers, especially the Canadian peers, followed this trend after us. And it became quite fashionable in the last 10 years for pension funds to invest more and more into private asset pools. Now many people are revisiting that because the challenge of higher interest rates, many of these private assets, especially if they're in fund structures or what have you, are struggling if they're leveraged and need to renew their borrowing at higher rates. For us, because it's on our balance sheet and we are AAA rated and we run a very low leverage profile, it's not been a challenge. We have been refinancing, obviously at slightly higher rates, but access to capital is never a problem to us. Access to borrowing at good rates has never been a challenge for us, so we can continue to invest in private assets prudently.
Okay. Do you think that this shift in strategy a little bit has been the single biggest factor in delivering your consistently high returns over that long-term period?
The game has changed with the interest rate regime shifting. It's once in a career kind of shift. So I've been doing this for 30 years. And even I can't remember the rates being at, the US Treasuries being at 14% in the Paul Volcker era, in the Paul Volcker era. So I don't think we're going back to those kind of anything similar to that. I don't think so. I think previous speakers today and on the panel before spoke about how there is one scenario in which we might get interest rates which are slightly higher for slightly longer than people would like, which would be not only annoying, but also would eat into investment returns. So in that regime, I think people in general, investors in general, will have to rethink how they want to invest their capital. Where we are seeing opportunity is that bonds which we had avoided, credit which we had avoided, now is looking like a reasonable asset class. It's not looking astoundingly cheap or anything like that, but at least, if you buy a triple B bond today, you can make some number close to 575, not 1-2% anymore. So that gives us a little more bandwidth in terms of, do you want to diversify our asset base away from private assets, which we can talk about later, but as markets corrected last couple of years, private assets haven't fully corrected. Globally, private assets are still in the process of correcting. It's a slow process. We think that will accelerate, so we're keeping powder dry. But in the interim, I think credit has been a pretty good asset class for us to get involved with and go back into.
Okay, speaking of asset corrections, how do you take advantage of market volatility, or do you actually take advantage of market volatility in that sense?
At a very high level, yes. So we always currently, we're keeping powder dry, and we take advantage of market volatility to buy some good assets. But as you can imagine, with our long horizons, our permanent capital, and our private asset portfolio, we tend not to trade much. We tend, it's sort of a Warren Buffett kind of style of investing. You buy really good companies at reasonable valuation and let the companies do all the hard work of creating value. We just kind of own them, and we will own them for a long, long period of time. So we don't churn the portfolio much, and if it's private assets anyway, that's not the strategy. We own these businesses, we like the businesses. As long as they're creating value, as long as they're still on strategy for us, we would continue to own them. So the way we navigate volatility is by making sure that we own very good businesses. We make sure that the balance sheet is always robust. We are always under leveraged. We always have powder dry. Then when there's a real opportunity, we can pump in capital and take advantage of a situation.
Okay. So shifting the questions a little bit. As the head of Asia Pacific with the global diversification strategy, I guess I wanted to find out more where you think the best opportunities are for 2023 and over the longer term. So OMERS is globally present, as you mentioned. So out of all the markets that you are present in, where do you see the most opportunity?
Just talking about Asia Pacific first, which is kind of my area of focus, which is all the way from Japan to Australia. So I have to talk about 3 different things that we are doing. So one is public equities. In public equities, our approach again is very concentrated. We only own 25 to 30 stocks. We hold large liquid companies. We hold them in fairly large positions, and we would not trade them much. So they again tend to be high quality companies where we trust the management, trust the balance sheet, think they have a good moat, and we would be happy to own them even 10 years from now. So those are the kind of companies we own. Japan right now has become very fashionable. It's done very well. It's popped up in the last 1 month again. We were there for the last period of time, for all the reasons that the previous panelists, the panelists on the previous hour spoke about. Good businesses, very cashed up, now paying dividends, now paying attention to corporate governance. Most of them, the ones we own, tend to be in the external sector. They're exporters, or they have global franchises, or technology which is globally competitive. We are not that focused on domestic Japanese businesses. So that's one area which has been very interesting. Australia has some companies which are world-beating businesses. We like those. India, it just so happened that we started the Asia Pacific. Australia was already a big business 5 years ago. But the rest of Asia, we started doing more just started 5 years ago. And we happened to go into India in a very big way because we thought it was very interesting at that point in time. It was much cheaper than it got to last year, and it's become cheaper again. But in the interim, over 3-4 years, it did really well, got expensive, and we did really well out of that. So much as we don't really trade, we did take some money off India when it got expensive, and right now we are very comfortable with where it trades. So India, there are opportunities. Japan, there are opportunities. China is a bit trickier for a number of reasons. We do think that it's a very large economy. It's the second largest in the world. It's probably bigger than Europe now, ex-UK. There will be opportunities. There have been opportunities in the past. There will be opportunities in the future. We own a few companies over there. These are all idiosyncratic in the sense we like the specific business. We're not there for China. They happen to be Chinese companies. We happen to like them, and they're really good businesses. Some of them have actually done very well despite China not doing well. Some have been more challenged because of the China situation. So we continue to look for value there. It's probably been oversold. Whether it comes back is a question mark. Not so confident about timing. With a longer horizon, we can kind of sit there and wait for it to come back. We would love to do more ASEAN. Liquidity and size of a company is usually a challenge for us. So these are the kind of interesting areas within the public equity space. And we do a lot in credit, which may not be of much interest to this group, perhaps, I'm not sure, but we do a lot in public and private credit, and especially in private credit, which is a very, it's a nascent market for Asia. There are very few players, and it's a huge industry in the US. We think many of those trends will follow in Asia as well. So we've been very active there, and we're making very good returns and very good investments in private credit. And then in the private businesses we have, Australia is already very well developed for us. India is a focus market. We'd love to do more elsewhere in Asia, but it will all be a question of opportunity.
Okay, so I want to go back a little bit into your views on ASEAN. So you already mentioned the challenges on liquidity, for example. But is there anything else that you think investors are concerned about ASEAN, which is why there's a little bit of a mismatch between FDI flows and actual flows into equities markets or portfolios?
I can't speak for other investors. For us, the challenge is mainly liquidity. So our typical cutoff, even for a single stock, would be liquidity of 40 to 50 million US dollars per day. So not many ASEAN stocks will make that cut. So that is our challenge. We'd love to own, I mean, in terms of the ASEAN markets, several of them, what are the positive features? Many of them are fast growing. They have a young population. There's a lot of opportunity, especially if policy aligns and becomes stable with what investors would like to see over the long run, which does happen. From time to time, you get a push forward. And then these countries, all of these countries become very, very interesting. Love to do more in ASEAN. I think we'll just have to be patient for these markets to bigger in terms of the listed equity space, deeper in terms of liquidity. What the countries can continue doing is just have really clear policy, which is forward-looking, which is receptive to foreign capital, which is transparent and stable. You don't want back and forth in terms of the direction you're going in. The opportunity set is huge. It's just a shame that sometimes those opportunities are not captured as quickly as perhaps they should be.
I see. So shifting the strategy discussion a little bit, I wanted to ask how OMERS thinks about sustainability in general. So I saw in the slide that you mentioned about diversity and how important it is for OMERS, but could you talk about how OMERS initiatives are towards sustainability, and also how you cut through greenwashing attempts, or also should investors basically care about sustainability?
The last bit is easy. Yes, we should all care about sustainability. If you just look at what's happening to climate globally, I mean, sustainability has many angles, but just look at one of them, which is the climate aspect of it. We would just be having terrible weather all over the world. last 2, 3, 4 years. Ocean temperatures now have crossed in April, in the last couple of months. We're north of the 1.5 centigrade mark that we've had as a cutoff for, this would be problematic. So we're already crossing that now. And it's going to hurt all of us, right, in terms of bad weather, difficult weather, cyclones, floods, drought. So we should all care about it. OMERS cares very deeply about it. We have a 3-point strategy on that. One is ESG, all aspects of ESG sustainability are factored in before we make investments. So any investment committee of ours, any investment managers that we have, they will not be able to take an investment case through OMERS unless they've looked at these aspects very carefully. Having done that, and only the best will qualify, best companies, best businesses on these aspects. Having done that, we don't stop there. We also then continue to engage with these companies saying, can you be best in class? Can you do better? Can you move to carbon zero if it's relevant for your particular business? Some businesses not relevant, but where relevant, can you move to carbon zero? Because we've committed to carbon zero footprint by 2050, so we need our companies to commit to those as well. And we are targeting a 50% reduction by 2030, and we are well on that way, achieving that. We want to continue to do more. So that's one aspect of it. And then the third is we also want to shape policy. So we engage with a lot of the policy bodies globally, which are involved in setting the rules, whether it's accounting rules, to come to your point about greenwashing. So there's a lot of abuses around companies claiming to tick all the boxes and claiming green credits and issuing bonds which may be cheaper or what have you, getting access to capital is cheaper. And they're not really working towards a better situation for the planet. So we want to make sure we, at the policy level, we engage with all the global bodies which are working on this to get the right outcomes and clamp down on greenwashing and all the bad behavior.
So do I understand it correctly that the approach is, or put another way, is the approach more to avoid certain sectors which are not so sustainability compliant, or is it more of a management from that company or from that sector?
So we historically haven't had an exclusion list. We would anyway, by virtue of focusing on the best quality business, you tend to be at the higher end of the spectrum in any sector in terms of the ESG, the sustainability aspect. These companies are generally better behaved in any case. But more recently, one of the things we're doing is making sure that our carbon footprint reduces by not investing incrementally in companies which have more than a 25% exposure to coal. So coal is something that we would watch very carefully and not invest incrementally. We have some general exclusions around arms and ammunition, around tobacco, around gambling. So these have been there historically. But from a climate perspective, coal is one industry where we are definitely watching out from an exclusion list. Our preference is much more to work with good companies, the best-in-class companies, and make them even better. Continue to nudge them. Nobody's perfect, and so if you already have a good footprint, can you make it even better going forward? So that's generally our approach, rather than excluding assets. So we don't really have, for example, I'll give you one example. We don't have a palm oil plantation investment in the portfolio, but if we did, we would go and buy the one company which had the best behavior in terms of sustainability in palm oil, and then we would work with them to make them even better and set a benchmark for the whole industry. Because it does put pressure on their peers to raise their game. So that's a positive kind of contribution to the whole conversation around sustainability.
Oh, that's very good to hear, because I know that the sustainability journeys of every country is also different. So that's good. So shifting a little bit on, I guess, your view on other asset classes. So given the trend in global policy rates, do you think that investors should look more into doing more credit?
That'll really depend on individual situations for investors, but credit as an asset class was, I think, fairly uninvestable 18 months ago. It is investable now. you'll have to pick your spots. Um, Asia is quite interesting because it's not yet a deep liquid market like the US is. However, and the front end of the curve for quality names tends to trade tight because that's what a lot of people are comfortable with and tend to own it. But still, there are pockets of value, especially if you go slightly longer dated. Again, with our kind of bias to avoid really volatile or tricky situations, we tend to stick with performing credit. Not necessarily investment grade, but within high yield, we would not migrate down to very low rated companies. Would stick at more at the split ratings, double B pluses or double Bs at most. And we found a lot of value there in bouts of volatility in the last 6-12 months. So we have a fairly large portfolio and positioned over there. So that's a long way of saying, yes, there are opportunities, and if it's relevant to you, and yes, there's a good nominal returns to be made on these on credit in Asia. I think the real opportunity is in private credit. Again, not accessible to everyone because there aren't that many private credit funds available either for the retail audience, especially for the retail audience. But if you're if you have larger check sizes, then some of those funds, especially the ones in Asia, are doing pretty well. We happen to own one of these companies. I don't want to market it, so I'm not going to mention the name here. But so they've done a terrific job for us. We've invested over $300 million through them, and the returns are really, really good. And again, we mainly invest in performing credit, still getting double-digit returns, unleveraged. Very happy with that outcome.
Do you think that ASEAN credit is more likely to underperform developed market investment grade credit, particularly the US?
Tricky question, because some of the the economic outlook for Asia Pacific is different from the developed markets for a couple of reasons. One is through COVID, Asia did not spend the kind of money the developed world did. So both monetary and fiscal policy were more subdued in Asia than in the US or Europe, developed Europe. As a result, Asia has a much smaller inflation and debt problem now compared to developed countries. So the dynamic is quite different. So I wouldn't be surprised that in Asia, inflation behaves a little better, interest rates, the credit cycle behaves differently from the US and better in the US, and which is why bonds may actually continue to behave better in Asia. So they're not necessarily, typically a triple B bond in Asia would typically trade 40 to 50 bips wider than the comparative US bond. At the moment, it's trading probably 20, 25 bips wider. So, one could argue it's tight. But when you adjust for all the macro backdrop, I think, these bonds could just hold value and do reasonably well.
Okay. So I guess I wanted to talk more about what OMERS is doing in the field of technology, digitization, particularly in AI, machine learning, and large language models. It's a very exciting field. I know it will impact a lot of the sectors today. So what do you think of these developments in these spaces?
Yeah, so we are watching this space, studying this space. We have teams which are looking at it, but we are in very early stages. I think it's developing fast. We are not a technology company. We'll invest in technology companies which may benefit from this. We have those kind of investments. We do have a focus on some verticals, especially health tech, in a fairly big way within our venture team, within our growth equity team, within our private equity team. So we're capturing some value over there. My view, this is my personal view, my view is that the use cases of applying the technology are going to explode, and we'll be hearing about this for the next many, many years. There's a lot of excitement, there's a lot of froth. I'm not sure how to value NVIDIA, quite honestly. Is it worth $1 trillion? Maybe, I have no idea. But I would look for opportunities elsewhere, and they'll unfold over the next 2, 3, 5 years. Again, we'll take a very long-term view, so we're not going to rush into this. We're studying it. We think there will be opportunity. We have actually the place where we are more interested is, we have a portfolio of 30 companies in infrastructure, 25 companies in private equity, and a bunch of other companies we own. How are these companies either vulnerable to or can take advantage of what's coming through? That's what we really focus on a lot. And most of the companies that we are engaged with, they are pretty much on top of things. They're doing what they need to do. Most of it is applying this technology. They're not doing fundamental research. Large language models are just one aspect of it. I think the place where this is really going to show use cases is in narrower niches or in narrow verticals. The generic model is useful, and using ChatGPT or Bard or Google or ChatGPT and Bard, and then Microsoft has one more on its Explorer. All these are very interesting, and they do throw out interesting answers, and you can incorporate them into your interaction with consumers in certain context through APIs and so on. But the real big deal will be, think about pharmaceutical research, where they're using a very narrow base vertical to do a deeper dive on new molecules, new chemical entities research. The ability to do that now will quite explode. And I'm here, and we know from our experience that, think about clinical research, the way it was done, the way you got patients or people to come in for clinical research, the way it was conducted, can change quite dramatically. A lot of that can be done through machine learning. So those specific use cases will take a few years to unfold, and they'll be very exciting, which is, in a way, generally good news for equity markets, because that's where productivity growth comes from. That's where earnings growth will come from for the people who succeed.
Is there anything about these technologies that concern you from sort of like an investment point of view? Or is it generally just exciting to watch unfold?
No, I think, again, a lot of this debate is in the public space. Misuse of these technologies is, these are very powerful tools, and they can be used in a very powerful way and misused in a very powerful way. So I think the last two US elections had a lot of meddling by various entities in terms of trying to influence how people think. Now, if you think you can leverage that many more times with these technologies, you can think about the interference that goes on and abuse that can come through and changing and shaping people's behavior. How do you know what is true if the internet is full of things that are being generated out of some of these technologies, right? So it will be a challenge. Globally, we have to figure out, can this be regulated? Should it be regulated? What are the boundaries? Where is the data privacy sit? So a lot of challenging issues. Again, not my competence or Omar's competence to answer these questions, but these will remain concerns.
Okay, thank you. So we're rounding out to the hour. I just wanted to remind the audiences that if you have any questions, please feel free to send them through via the QR code on your IDs, and we will definitely read them on. Okay. So I have one question here on, I guess this is overall strategy on general pension funds. So there are large national pension schemes put in place across ASEAN. So we have EPF in Malaysia, CPF in Singapore, BJP in Indonesia. Do you think that governments is there anything that the governments can do to address the challenges brought on by, let's say, an aging population and a new generation of an informal workforce, for example?
That covers a lot of ground. Aging population, thankfully half the countries in our universe don't ever deal with it. They're very young populations, so we can postpone that question for them. Their problem, whether it's India, Indonesia, or Philippines, is more around how do you create jobs for all the young people coming through the population curve, and can the demographic dividend be translated into something concrete in terms of economic growth, in terms of opportunities for these young people. But there are other economies, clearly. Japan's one of them. Korea is China. They all have a very real problem. Within the next 10 years, you'll see that. Um, Shrinking populations, aging populations, and how do you deal with that? I'm not sure whether the government pension funds, sovereign funds can play a direct role. I think it all hangs together at a policy level. Singapore is a good example of how we think about doing things. The CPF, for all its positives and negatives, is an attempt to make sure that people have adequate savings, including savings for medical situations and so on. So that's one aspect of it, and then this money is hopefully invested, in a good way through the entities that we have in Singapore. So it's a fairly thoughtful approach, long-term approach. I think everyone can benefit from thinking about it that way. Australia has a very good pension system. People really, the average person, especially the younger, I have a lot of family there, and the younger people actually don't like it. They're saying, I'm not going to see this money for the next 30 years, so why am I putting it in? But from a systemic perspective, from a managing your retirement perspective as a society, these are probably good initiatives. Canada has a smaller one growing. I think they look to Australia and saying that's a really good one. Maybe you should do more of that. So aging will have to be managed in multiple ways. One of the things that France is trying to do, and others will have to think about it, is how long should you be working? In some countries, retirement ages are probably can be extended. People are living longer, people are healthier longer, and actually staying in the workforce actually is going to keep you healthier for longer. So again, these are all public policy debates. I'm not the expert. But these are all relevant questions from when it comes to investing. Your other question was around?
Just the informal sectors, kind of like developing.
Yeah, again, public policy question.
Right.
I think you'll get better answers from public policy experts.
Okay, we have a question from the audience. So let me just read it out. With liquidity being a constraint to invest in ASEAN, would you be interested in investing in a wide range ASEAN ETF covering large and mid-cap companies?
Yeah, I think that would be a relevant strategy for some people. We invest directly. We don't invest through funds. There are pension funds who actually allocate money to either ETFs or even active fund managers. We don't. 95% of the money we manage is managed directly by us. So we wouldn't do that. In a past life, when a client of mine wanted an ASEAN type exposure, we created a separate fund, because in a Asia Pacific fund, ASEAN gets lost and very small. So for this particular client, we created a $400 million fund which focused only on ASEAN, and they got the exposure, and the fund actually did very well. So that's a valid strategy. ETFs are a valid strategy. I think, just thinking aloud, I think a cunning plan would be, and this is not going to happen, but a cunning plan would be to ASEAN to come together on one platform, on one exchange, to create a deeper liquidity pool. It's not going to happen. But, how do you compete with the giants around you in the region? If you think of the size of the economies of China and India, you'll get dwarfed at all times, right? So I think there has to be a more cunning strategy than trying to do it alone.
Okay, thank you for that. The next question comes from the chat box as well. Based on the investment strategy that you have described, would it be correct to conclude that growth and tech stocks have no place in Omar's portfolio? Tech.
Oh, no, we have a fairly large exposure to both growth and tech. It's just that we wouldn't do things which have very distant cash flows and not a proven business model. So I think somebody else in the previous panel talked about, growth. The big 5-7 companies in the US, the tech companies, have done really well. Actually, most of the performance for the S&P 500 this year has come predominantly from those. But 60, 70, or maybe 80% of the other companies, the ones which were new tech, no cash flows or no visibility to profit, they're all down a lot, 70, 80%, and they're still struggling. So we don't tend to own those. But if you look at the big 7, and I won't name them, but we probably own 5 of those 7, right? So we would definitely own technology, we definitely own growth. It just has to make sense to us. And we keep it fairly simple. If it makes sense, we'll own it. If you take simple metrics like price to sales or price to revenue, price to earnings, are just numbers that don't make sense and need heroic kind of assumptions that this company will actually conquer the world. And some of them do, like, Tesla did that. And there often is a company which will do that. But we are not in the game in predicting that and betting on that. We will stick to simple stuff.
Yeah. Okay. So the next question is, do you believe that the recent scare in the banking sector post Credit Suisse and SVB is over? And do they present great opportunities? Do you think they present great opportunities?
So Credit Suisse is probably is a special case because in broad Europe you haven't seen, there will be stresses, but you haven't seen the Credit Suisse kind of stress in broad Europe. So I think Credit Suisse is probably a special case. US is more interesting where the smaller banks like SVB had made basic banking errors in terms of ALM mismatches and so on, right? I mean, so if you do that, then you're very vulnerable to a change in a shift in regime, and we had one of the biggest shifts in regime in the last 40 years. So obviously there will be some pain there. I think the next set of pain will really come from the credit cycle, and that will depend on whether we get a deep recession or a shallow recession or no recession. I think if you have a scenario of a very shallow recession or no recession, I think the credit cycle can also be benign, which will give all the banks there a lot of space to recover from whatever they need to recover from. Where they do not have strong deposit franchises, they're clearly hurting. Where they need to market any long-term bonds they held, and they haven't taken it through the balance sheet, they'll need 4 or 5 years to wash it through the balance sheet. So if they get a 4 or 5 year window where the credit cycle is benign, I think they'll be fine. They can cope with it. But if you get a nasty credit cycle, then the pain of having to take credit losses as well as marking to market the long asset book, that might become quite challenging for the smaller banks. Again, not for the big bank, the big well-managed banks. Again, we don't invest in those smaller stuff, so and we've been underweight US financials in the past, so we are not too worried about our exposure. But if you owned a JP Morgan, you'd be fine. If you owned a small regional bank, you do need to go check the numbers very, very carefully.
Okay, so I have last 2 interesting questions given the limited time. The first one is a little bit related to technology and the fast evolution of it. So AI is set to eliminate millions of white-collar jobs. As a pension fund, are you worried about the loss of income contributions, and how are you preparing for it?
So I think the assertion that AI will take away millions of jobs, was it thousands or millions of jobs? I think that needs to be investigated some more. I don't think we have evidence that that's necessarily going to happen. Throughout history, whenever there's been new technology, that's always been the scare, right? So when cars came in, we said, what will happen to all the drivers of horse-driven carts? They found other work. Usually the challenge is if the transition is very quick, then you can't retrain people, you can't shift them into new jobs quickly. My own sense is that everything that's happening now, despite all the buzz and despite all the hype, it's a good thing, but it'll also, the use cases are going to develop and come through over the next 10, 15, 20 years. And we'll have some so on the positive side, we're going to have some amazing outcomes on the health side, for example. Our ability to provide good quality, real-time healthcare, especially to the bottom half of the population, because cost to serve is going to drop dramatically. Targeted healthcare provision can be now made available, is going to be very, very positive, right? Similarly, education. If you can take the best lectures in the world by the best teachers and package them, make them available globally, we can do that even now. You don't need AI for it. But more of this is going to happen. Use cases are going to develop. We can bring a high-quality education to the poorest child in the poorest village in the world, right? So we can make a lot of these things happen, which is generally good. Will there be disruption in pockets where some jobs will disappear? That has always been the case for the last 200 years since we had industrial revolution, and that will continue. And I don't know what that equation is, whether the gains will outweigh the losses. My sense is generally with technology, that does tend to happen, that the gains outweigh the losses, and net we are better off with better productivity and better outcomes for for society.
Okay. So I guess net positive still.
That's my bias. I
Right.
think it'd be very hard for anyone to prove that assertion right or wrong
Of
one way or
course.
the other. We can all have our guesses. It would be very hard to prove it today. We'll know in 10, 20 years' time because it has to be backward-looking analysis.
course.
Next 10 years, something will happen. The 10 years after that, economists will study it. And so in 20 years from now, they will report to us what happened between 2023 and 2033, whether machine learning AI was a positive or negative. There's no way to know the answer to that
Right.
today.
Correct. Okay, so the last question that I have for you today is more of, okay, so how much geopolitical risks play in your capital allocation decision process for OMERS particularly?
It's become fairly important the last 5 years. I don't know how much people have tracked Canada's position with China. It has been very delicate because the two Michaels who got imprisoned in China in retaliation for something that happened in Canada, that made things very, very tricky from a geopolitical perspective for Canada especially. So all Canadian pension funds are being very careful about how they think about China. In our case, we never had any onshore investments in private assets. Most of our investments are public and liquid. So if we wanted to, we haven't changed our minds, but if we wanted to change our minds, we could do that quite quickly and easily. I think the big debate right now is, are you going to disengage with China or are you going to de-risk China, right? I think decoupling is out of the question, my view. It's more about de-risking, and that's what everyone's doing. So when Apple says it's going to produce 25% of its phones in India, that's a de-risking strategy. A lot of other people have similar strategy, whether you call it China plus one, nearshoring, friendshoring. There's so many different labels around this. They're all about de-risking, which would probably have been appropriate even if the geopolitics wasn't that difficult, because China's aging, manufacturing China is getting more expensive, and it'll get even more expensive as China becomes a richer country. So that would have been sensible even in the past, but the combination of geopolitical risk as well as in the COVID situation, the resiliency of your supply chain, that's become top of mind for most people, and everybody wants a more resilient, more de-risked supply chain. So that is going to happen. From our perspective, that then throws up opportunities. Okay, so where do you want to invest? If this is going to be what's going to happen in the next 10 years, maybe there are new opportunities for us. So one of the I'll give you just one example.
Right.
So one of the consequences of this is that you need to build a lot more warehousing capacity closer to consumer markets. So in the US, closer to US and so on. So that's been a sector in our real estate portfolio. We've been investing a lot more also in logistics, infrastructure. So that's one positive, not positive, there's an opportunity that comes out of what's changing geopolitically. One wishes that the geopolitics was better, because that would mean a better and more stable world, a little more growth. But we have what we have, and that's not going to change, I think.
Okay. I think that's all the time that we have today. Thank you so much for joining us, and thank you everybody for joining the last session today.
Thank you. Thank you, Ashish. Thank you, Jackie.